Three, two, one. What's up, Jerry?
All right. Welcome to the show on Christmas Day.
No, man. Obviously,
How about
we're
that?
not.
It's the
We're,
Christmas show.
we're not doing this on Christmas. We recorded a couple days before, but that's okay. Hopefully, everybody is having. If you celebrate Christmas, hope you're having a great Christmas. If you're watching this, you must not be having a great Christmas.
Well, maybe you just need a little break from all the festivities and
Yeah,
get
that's
on
true.
YouTube and check us out
That's true.
there.
Grab yourself some eggnog, or in my case, I always make some coquito. I made some
There you
homemade
go.
coquito the other day, so I'm ready to drink it all weekend. What you got for us
Very
this week,
nice.
man?
Well, uh, TSP Weekly Podcast, 25 December 2022. Um, Big topic of conversation this week is the Santa Claus rally. So I want to go through what exactly the Santa Claus rally is, what it's not, and kind of what the implications are if Santa does not show up on Wall Street this year. Then we're going to take a look at the F Fund. A lot of talk about the F Fund and kind of more generally bonds doing better than stocks overall next year. So we'll take a look at that and then the TSP fund charts. Okay, so Stock Traders Almanac. I know a lot of you guys have heard of it. If you haven't heard of it, you definitely want to go check it out. It was created by Yale Hirsch. The first annual edition came out in 1968, and his son Jeffrey has since taken over as the editor of the Stock Traders Almanac and the CEO of the publishing company, Hirsch Publishing. So Yale Hirsch, he worked all this in seasonality and cycles and trading patterns, and he came up with some really interesting rules that you can definitely use to apply to different trading styles. His best known really is a thing he called the January barometer, and it's kind of broken down into three parts, and we're going to kind of go over that a little bit. So, Santa Claus rally, mid-December low, and the January indicator trifecta. So this is basically cut and paste. I didn't do the whole article, but it's an article from jeffhirsch.tumblr.com down there. This is part of the free site, so it's a blog on their site. You can get to this for free if you want to. You can buy a subscription to Stock Traders Almanac, and they will actually send you the book that's the annual actual almanac. So Wall Street, and this came out on the 15th of December, so it's very recent. Wall Street, mainstream media, and social are abuzz with the Santa Claus rally chatter and hype this week, but everyone has it all wrong. Okay, this is Jeffrey Hirsch saying this in his blog. So everybody has it all wrong. I can see Yale's big grin shining down on us as a famous indicator uh, and catchphrase reverberate on the street, Wall Street. They argue their case for why the Santa Claus rally will or won't come to town this year, but they miss the point. Yale Hirsch invented and named the Santa Claus rally in 1972, published in the 1973 Almanac, and it's still misunderstood. Okay. It's not a trading strategy. The idea is not to use this as a trading strategy. The idea is to use it as an indicator for the following year. Okay. It's designed to be an indicator. So, Santa Claus rally is the short, sweet rally that runs from the last 5 trading days of the year to the first 2 trading days of the new year. So for us, that actually begins on well, if you're watching this video, it began on Friday. Okay. S&P posts on average 1.3% gain if the Santa Claus rally happens. So over that period of time, the last 5 trading days of the year and the first two trading days of the following year, if we get a Santa Claus rally, the average rally is 1.3%. Failure to rally tends to precede bear markets or times when stocks could be purchased at lower prices later in the year. This is really the key, right? This is kind of what everybody's talking about. If we do not get the Santa Claus rally, it's a bad omen, put it that way, for 2023. So this was the famous line from Yale Hirsch: "If Santa Claus should fail to call, bears may come to Broad and Wall," which is the intersection of Broad Street and Wall Street in downtown Lower Manhattan. So here's what it looks like. It's supposed to be an indicator, right? It's not supposed to be a trading methodology. So when the SCR is a Santa Claus rally, in 94 it was down a little bit, and for the year we were down 1.5% for the year. All these years it was up, the amount that it was there, and these years were up. Okay. 2000, 2005, 2000, we have a pretty big negative Santa Claus rally and a big down year, right? And it's not always 100%. So in 2001, that was, in the middle kind of the crash that began in 2000, but we were having a recovery rally at the end of 2001. So we did have a Santa Claus rally, but for the year we finished way down because we were in the middle of a long-term bear market, and same thing going into 2002. So it's an indicator, it's a tool, but it's not designed to be kind of the only tool that you would use to trade for the year. Okay, so you can see how the rest of it went. Santa Claus rallies from 1994 to 2022, and where we are right now, going into this year, we had a 1.4% Santa Claus rally. So we were just pretty much right at the average Santa Claus rally in 2022, but we are, as of the closing on December 15th, we are down quite a bit in the S&P 500. So again, it's a tool, but it's not the only tool in the toolbox.
So, okay, you going to talk a little bit more about it?
Yes.
Okay. I was just
Go ahead.
thinking.
What do you got?
No, I'm going to let you finish because I want to see if you're probably going to answer my question as we go forward, as to how, again, for folks that may not have watched a lot of our shows or new or something, but the how to use this as an indicator each year. Is this something that you would as you were explaining, just something we would look at to use for next year, but how we might do that. So I'll let you keep going.
Yep, we're going to get to it a little bit.
All right, I'm impatient, man.
So, okay, so like he says, the current situation, which is right now, and this is now we're getting into opinion. Okay, again, this is a blog post from December 15th. So this is Jeffrey Hirsch's opinion in this blog post. The current situation is reminiscent of 1974. Midterm October low, a December retest, lots of dire news and conditions, right? This is exactly how it is right now and how it was in 1974 around this time of the year. The Fed is clearly done taking orders from Wall Street and Washington and is bent on halting inflation, right? I think the market finally gets that the Fed is going to raise rates. It's solely focused on halting inflation. The quarterly dot plot ticked up, looks like at least one more 50 basis point hike that we should get in the beginning of February. It's working. Inflation is decelerating. Reality is we will have higher inflation and higher rates for a while. And that's what the Fed is saying. They expect to have higher rates for a prolonged amount of time. But we really have already been in a bear and likely a recession. So he's saying that, yes, 2022 was a bear market. We're still in it and likely in a recession. So if you remember back earlier in the year, we had first quarter and second quarter of negative GDP growth, which is technically the definition of a recession, but it never got announced as a recession because some of the other things that they look at, along with two negative quarters, weren't in place. So they didn't come out and say it was a recession. But Hirsch is saying here, we've been in a bear market and likely in a recession. Bear markets bottom before recessions end, and bull markets start when the street least expects, and practically everyone is a bear right now, right? Everybody thinks the market's going lower. We did the show last week, last weekend or the weekend before. We kind of reviewed, 8 or 10 of big financial firms and their expectations for next year. Virtually all of them expected the first two quarters next year to be down and have a significant rally in the second two quarters. So everybody on the street right now is bearish. While it sure looks ugly out there, we contend that the worst is behind and a nascent bull rally is trying to emerge. So what he's saying is he thinks that although things look ugly, they're saying Hirsch is saying that the worst is behind us. The bottom that we had in October is probably the actual bottom of this bear market, and right now we're in a bull market that's trying to emerge. Okay, so he's bullish. Stocks tend to bottom here in mid-December, ahead of the seasonally strong last half of the month, especially small caps, what used to be the January effect. We're going to talk about that in a second. The results of the Santa Claus rally, along with the other two components of our January indicator trifecta, the first 5 days of January and the full month of January barometer, also created by Yale Hirsch in 72, will help solidify our outlook for next year. So let me pull that apart a little bit. There's three components to what they're calling the January barometer. Okay. January barometer. So the first is the Santa Claus rally. Okay. Santa Claus rally is the last 5 trading days of the year and the first 2 trading days the following year. That's the first component. The second component is the first 5 trading days in January. Okay. So if you've heard the term, so goes the first week of January, so goes the first week, so goes January. So the idea is if the first 5 days of January are negative, then you're going to have a down January. Okay. That's the second piece. And the last piece for the full January barometer, as goes January, so goes the year. Okay. So you start with the Santa Claus rally. Then you have the January effect, and then you combine the 3 of them for the January barometer. And that's what is the indicator for the following year. So this is where he sees us right now as of the 15th of January. So this is a chart from the blog post, and these are the dates. Okay. So what he's saying in here, these numbers are the trading days in December. Okay. And down here are the actual dates. I put them in. So what we're talking about, the Santa Claus rally for us is the 23rd of December to the 4th of January.
So this chart is December?
Yes.
Okay. Sorry.
And this is December. It's a very busy chart, but it's actually
It got a lot of good info, but it took me a second to kind of see. So the bottom lines are historical, and the top lines are where he left off as of the 16th.
Right. The dotted lines is what's actually happening in these indexes up here.
Mm-hmm.
And the solid lines are what the average projections should be going forward from 2001 to 2021. Okay, so that's how they get these lines.
Got it.
All right. So what he's saying is, this is where, the blog post came out on the 15th. And so this is where the dotted lines are where the market was as of the 15th, which is, I guess, the end of last week. And what he's expecting is we find a bottom here in December, and then we start moving higher into the last couple of weeks of December, and it's led by the small caps, which in our case would be the S fund. That has not panned out so far. We're recording this on Thursday. Today is the 22nd. So he had called for a rally going into the 22nd, and that's definitely not what we got. So we'll have to see how the rest of it plays out. But again, it's an example of why you take this into consideration. But if you had read this blog post and based on his analysis, you bought the stock funds here, you'd be down. So for me, this is great information, and it creates kind of a bias, right? Because I'm looking for reasons to get into the stock funds at this point, because the seasonality drives it that way. But if the price doesn't tell me to get back into the stock funds, I'm not doing it. So hopefully that makes sense. We said 3 parts of it, right? When all 3 are up, the S&P 500 has been up 90% of the time, 28 out of 31 years, with an average gain of 17.5% for the year. Okay, so the January effect is a big deal. The January barometer is a big deal. So if you get the Santa Claus rally positive, and you get the first 5 days of January positive, and you get a positive January at the close of the month, right? If those 3 things happen, then 90% of the time, the year is going to be positive with an average of 17.5% gains. Okay, but it's statistics, it's math. It doesn't mean it's going to happen this year. Okay, when any of them are down, the year's results are reduced, and when all 3 are down, the S&P was down 3 of 8 years with an average loss of 3.6%. With bear markets, okay, in 69, 2000, 2008, obviously 2000 and 2008, those most recently, those are the biggest bear markets that we're looking at. They were flat in 1956, in 78, 2005. Down trifectas were followed by gains in 1982, almost 15%, 2016, 10%. So again, there's a lot of statistics that goes into this. It's not, basically I overlay it with technical analysis. So this is not a technical analysis driven, it's a data driven sort of methodology. And there's definitely some correlation. If you can show that if all 3 of the pieces are in place for the January barometer, then 90% of the time you have an up year the following year, then you should go into that year. If January closes and all 3 of them hit, you should expect the rest of the year to be positive. So your bias would be that the market's going to continue higher. So how you would use that is the market comes down to the 20-day moving average line. Let's say it's been going higher, it corrects down to the 20-day moving average line, and it closes right on it. Maybe you'd give it another day, right? Because the bias should be to the upside. Because we're going into the year, in this kind of setup.
I mean, generally speaking, we would probably give it another day either way, but you would definitely be able to be more anticipatory using that historical data and the projections from it to be able to say, okay, it looks like, this is a little predictive, right? Which we're usually more responsive than predictive, but there's nothing wrong with using historical data to like Jerry's explaining, kind of give you a bias. Like it would be called an educated bias, right? Not a sort of emotional bias. That's very different because, I just want to make sure to separate the two. And I know Jerry does it very well, but I kind of want to point it out for our listeners that that's a very big difference, right? So an informational bias, a data bias is not the same as an emotional bias. An emotional bias is I just hope it does. I wish it would. Like, I really do wish Santa Claus would show up and it just skyrocketed, right? But that's not
right.
That's not how you want to approach this, right? So, but back to your example, Jerry. I mean, sitting there, it hits the moving average. You give it a day. If it goes against you, if it goes against the prediction, right, which is that it would go back up, well then something's changed. Which in our world that's a change in a trend, right? That's even more. It's where I'm kind of trying to explain is you can almost use it either way, right?
Sure.
So the predictive analysis was that it was going to, kind of go up. It hits the moving average maybe one day, the next day it goes down past it. Now you're saying to yourself, well, that's really against, the projections. So that helps you make a more of a confirmation that, hey, this isn't just normal, right?
Right. Yeah, I mean, everything you said is exactly right. It's just like any other kind of analysis. You
That's
put together
rare,
your best. What's that?
that I'm right. That's pretty rare.
No, I mean, you put together.
I always try to think like, I'm always trying to play the dumb guy, which is not hard for me, which is, folks that are watching it that aren't, as in tune with what we do and how we do it. And we never know when you're going to come across our show or whether you've been watching it for 2 years or whatever, right? And so I try to think to myself, what questions, might I have if I just kind of wandered across it. But I mean, what's funny though is as much as we've talked about the Santa Claus rally, this is the first time that you've kind of explained it this way, right? And I think in the past 2 times that we've done it, we've talked about it. It wasn't really explicit that it was more of an indicator than a trading tool. I don't know if that's the right word.
Right. No, actually, I just subscribed to the Stock Traders Almanac, and so I've been reading it a lot more in detail. I mean, I knew what it was before. I mean, you can go to Google and get a pretty good understanding of it, but if you actually subscribe to the Stock Traders Almanac, it goes
funny
much
how
deeper
that is. Once you actually pay for the data, you get a little bit more.
Right?
We're very familiar with that. A lot of people go, well, hey, how come you didn't talk about this? Well, we do, if you remember.
Right.
All right, cool.
All right, so let me just finish
Keep
up
going along.
on this piece. So keep your eye on the Stock Traders or Santa Claus rally for signs of a new bull or continuing bear. Okay, so while he's bullish, he's saying keep your eyes on that Santa Claus rally because it's the first of the 3 of the January effect. Okay, so we're either going to get a new bull market or the bear market's going to continue. Then watch for the rest of the January indicator trifecta. The January barometer and the first 5 days. FFD is the first 5 days of January, and the January barometer and the Santa Claus rally are the 3 that we put together. When all 3 agree, the market generally follows suit. We are anticipating a Santa Claus rally this year. Inflation is easing. The Fed's likely to be done with rate increases in Q1, right? We should get another 50% basis point move in February, and we may or may not get it. It may or may not continue to hike, but he's saying that we should have the last one in Q1. We also see supply chain constraints fading now that China is loosening its COVID-19 restrictions. Seasonally speaking, we are also in the middle of the historically strongest period for stocks. The sweet spot of the 4-year cycle and Q4 of midterm years through Q2 of pre-election cycle. So there's a lot of cycles that are overlapping right now that are bullish. And at the same time, when everybody is bearish, the opposite tends to happen. So he's putting all these things together and he's saying, yep, it makes sense to me that we're in the beginning of a new bull market. And so it remains to be seen. So like you said, the first thing the first thing is going to be the Santa Claus rally. If we don't get the Santa Claus rally, then obviously we're not going to have the trifecta. So we shall see. It's going to be an interesting week. And again, January 4th. So whatever happens between Friday's closing price and January 4th's closing price. All right, switching gears. The F fund and bonds generally versus stocks and what the charts say versus kind of what the consensus is. So the theory goes that there's the 60-40 portfolio, right? When it's a very well used, very common portfolio for fund managers. You have 60% of your money in stocks, 40% in bonds, because generally speaking, when stocks go up, bonds tend to be flat. And when stocks go down, where else are you going to move your money to? When the stock market's going down, you're going to move your money into bonds, which pushes the price of bonds up. So since the majority of the time stocks are moving higher over time, right? The majority of the time stocks are moving higher. So that's why you do 60 stocks, 40 bonds. You're trying to minimize downside risk and maximize gains to the extent that you can. In 2022, both stocks and bonds have come down together, right? Which is why everybody is wiped out this year because there's nowhere to go. When stocks and bonds and now real estate, everything's going down, there's nowhere to go.
Yeah, and I think it's good to point out too that, a lot of people that do, it's not that the 60-40 split is like a bad idea, right? But it's also good to remember that the people that generally prescribe to that are not actively managing their money.
Right.
They sit down with their financial planner, if they even have one, 4 times a year, maybe twice a year, and they kind of shuffle that 60/40, but it's still 60/40, and it's really just kind of a set it and forget it mentality because, like Jerry explained, historically, those are the things that happen, right? If stocks, you just explained it all. The problem is when that doesn't happen, right?
Right.
Which is why we are so adamant about at least being more active in the management of your investments, right? It doesn't mean you have to do it every day like a day trader. What we prescribe to is that the average investor, particularly in the TSP, really can just look at the information once a week, make your decisions for the upcoming week, and that's it. You don't need to look at it every day. Once a quarter, once a month, you probably could get away with. Once a quarter, you're going to get hurt. So anyway, the point is like this whole mentality that we've all grown up with, and it's really our generation, because the generation prior to that, there were so few people that understood anything about the market at all, right? Of course it existed,
Yep.
but you had to be in a very, very small part of the world, think that's what you were thinking about, right? And so in our generation, our parents, our grandparents, they were the ones that kind of started telling us, because this is what they were told. These are the kind of the things that they were told you do, and it's because historically that's kind of worked, right? Except when it doesn't, and that's when
Right.
we're living through a time that only certain generations have ever seen, and we're living in a time where those historical truths are not being carried out. And so if you just stick your head in the sand, you're going to be hurting.
Yeah. The tools, most of the tools that we use now that we take for granted were created like in the 70s. Mutual funds and ETFs came along later, but the idea of mutual funds and that you could just contribute to a basket of funds. I mean, that whole idea of putting stocks into a basket, and then selling the basket. It was a really interesting way to bring more of the public into the stock market.
Right,
And
because
then
at the
once
time
401ks came along,
you couldn't buy, the average person couldn't go buy. Um, I'm trying to think of a company that might have been AT&T or GE or things like that. Like if you wanted to go buy, you had to pick up the phone. You had to find a broker. You pick up a phone,
yeah,
call them, get through all their gobbledygook, right, and say, hey, I want to buy 500 shares of, and you probably didn't anyway. It wasn't practical
right.
at all.
You couldn't have a basket because at some point, I mean, even if the share price is only $10, uh, if you wanted if you wanted access to a broad kind of pool of different industry groups within the country, there was
Yeah.
no S&P 500 that you could buy. You couldn't buy the SPY or
No.
SPX. You couldn't buy any of that. But once
So
that
you would have to
started,
go out and
now,
buy all those individual companies, and you
right,
probably couldn't afford to do that.
right. But so now, and now it's even more convenient, right? With fractional shares and everything else, you can pretty much buy anything you want. You can build any portfolio you want, um, and if you know what you're doing, that's awesome.
Yeah, that's
You
that's
can
the
manage the portfolio.
that's where you just nailed it, right? Education, and that's really what we're trying to push the most is education. I didn't want to get you sidetracked there, brother, but I just think that
No,
that whole 60/40. I mean, we you and I we talk about this stuff all the time. How all these kind of fundamental things that we've been told are the truth, um, are not holding up. And there's so many people that we know, literally tens of thousands, right, of people that we don't personally know, but that we watch in social media. Tens of thousands of people are so committed to these old truths, and are just their investments are collapsing because of it.
yeah, yeah.
Sorry to be a bummer on Christmas Day.
Yeah. No, it's
But
unfortunate because you're right. It's all about education, and if you're willing to spend a little bit of time and just look at it on a weekly basis, it's like riding a bike. You watch the show, you look at the charts, you start to get the hang of what it is, and then you can see it. You can see the Elliott waves wave patterns start to emerge. You can see when the retracements happen, and then you throw up the Fibonacci tool and you go, yeah, it looks like we're about, we've recovered half of the losses. And so you start
Or
to
you
understand what we're
do what
doing
I
here.
do, and I let you do it, and then I watch it on Sundays.
Exactly.
All right, get back into the F fund,
All
Brad.
right. So let me do the F fund. So the conventional wisdom right now is that bonds are going to do better than stocks in 2023 because we talked about it before. Everybody, and it almost is literally everybody, uh, thinks that prices are going to go much lower in the first half of 2023. So if everybody thinks that prices are going to go lower in stock market in 23, then they should flip and start buying bonds, and that will push the price of bonds up. So what has to happen if that happens? So that's the theory. Okay, if that happens, it's breaking this trend from the whole year. Okay, so if that happens, because right now we said stocks and bonds have been going down together since 2022. So here's 22. Bonds had already peaked back here in 2021, but at the beginning in 2022, when the stock market started rolling over, stocks and bonds were both moving in the same direction, down. Okay, so we've been in that state for a year. So that's a pretty strong trend. The thesis is that next year, because now everybody is convinced that stocks are going to collapse, therefore they're going to move money from stocks into bonds and bonds are going to go up. So that's the thesis. But if we look at the chart, right, we start back here on the F fund, because for bonds, for us, we're talking about the F fund. We have a very clear Elliott wave, 1, 2, 3, 4, 5. So we've completed a 5 move down to the October low, okay, from the peak back here in August 2021. So after you get a 5 move down, you get some kind of corrective pattern. Usually it's an ABC, but you get a corrective pattern. So we said A, B, C for a 2 that generally takes you back to the 4 of the previous cycle. So when I drew this, I'm thinking this is roughly where the rally in the F fund should end. Okay. Basically around the same area as the 4 from the previous cycle. So then I did the Fibonacci retracement tool starting from the top in August 2020 to the October low, and the 38% retracement is right here. So retracement ordinarily will see price come back up to one of these retracement levels. 0.382 is a 38% retracement. So let me back up. What does retracement mean? Wherever you were at the top right here to the bottom in October, this is the whole amount of loss that you had. If you retraced 38%, 38.2% of that loss, this is where price would be. If you retraced or recovered half of your loss, it's that 0.5 level, right? So ordinarily, the corrections or the retracements come at 38%, 50%, 61.8, or 78.6. So, and you do it on different time frames. So I did from the top to the most recent bottom, and the 38% retracement level is right here. Okay. Then I did the most recent high, which is also the top of the foreleg, to the low. And that takes us, the 78.6 retracement level is right here. It's pretty close to the 38% retracement level of the longer term. Okay. So the more of these that overlap, what you're doing is building like a zone where you would expect price to come up to and then roll over. So you got the 4 from the prior wave. You got the 38% retracement level right here, and the 78.6 retracement level from the 4 high right there. So somewhere in this box is where we would expect the F fund to get up to before beginning the next move down. Okay. Does that make sense so far? So
I think everyone said
what that
yes.
kind of so the thing is, what that implies is we get some kind of correction from A, right? So I put this chart together on December 17th. All right. So as of now, we are somewhere in the middle. We're down here somewhere because the F fund has rolled over a little bit. So we're in this B wave right now. So we get down to a certain level. And then what I would like to see is some kind of stopping here, and the F fund starts moving higher. So what will probably happen is the F fund starts moving higher, the stock market will start. Well, if the stock market starts going down while the F fund is going up, then it's very possible that the consensus was correct and the F fund keeps going, right? Because for all of this year, when the stock funds were going down, the F fund was also going down. So if we do get a rally in bonds, but the stocks keep going down, then the consensus estimate is correct and this will be wrong. But if that's not what happens, if the trend that's in place now stays, we get some kind of correction, this ABC, for a 2, and then the F fund starts going down, which means interest rates are going up. So it will be completely at odds with what the consensus is right now. I don't have a much better way to, until it starts playing out more, I don't really want to get into it too much more, but this is the opposite of what people are expecting, except it's what the chart is calling for. So it's going to be really interesting to see how this whole thing plays out. The alternative to this would
And the good thing
be,
is, if you just keep watching this show every week, we will be talking about it. So you won't,
oh
you
yeah,
won't be
100%.
blind to it. We got our eyes on it. I mean, because a lot of people are hoping, right? Are hoping that they can get some sort of love from the bond world, right? Because there's a lot of people that are unwary about where the market itself is going, and so bonds might be a place. A lot of people with a lot of money right now are looking at bonds, if not already in them. And so if you've got your money in bonds, if you're 60-40 bonds, right,
Yeah.
or something like that, 70-30, I've heard some people talking about, then you really want this to kind of rocket up. So we're going to have to watch it, though, and you can't just put them in there and hope.
I would I highly advise against putting anything anywhere and just hoping.
Exactly.
Definitely go back and take a look at. I shared out a YouTube video on Friday from a Swiss, uh, finance guy. He has a lot of really really important macroeconomic and kind of political information in there. So there's a lot of stuff in there, but for our purposes right now, what he's talking about is a roller coaster decade. Okay. Maybe not exactly. He's really more referring to like what was happening in the 70s, more so than kind of the roller coaster that we had from the top in 2000 to the bottom in 03, back up in 07, back down in 09. He's more talking about shorter term, up, down, up, down, up, down for like 10 years. And he goes into some pretty good detail about why you in that kind of environment, you absolutely do not want to just buy the index and hope for the best. So it's well worth listening to that part of it, and the part the geopolitical kind of what's going on in the world. It's a pretty fascinating video. Okay, so that's kind of the long term look at the F fund. In the shorter term, how would you kind of play this? Here's the Fibonacci level from, again, the October low to the most recent high on the F fund. And so what we're looking for is somewhere, because right now we're saying this is A, B, and then C is going to be up here, and then the F fund comes back down, right? So we drill it in a little bit, and we're looking for, if we have A here, we're looking for where is a likely turning point for B. So let's say price comes down to the 61.8 level. So F fund gets down to about 96. And at that point, RSI has started to turn up, CCI has started to turn up, MACD kind of things are starting to turn. It looks like we're getting support there at that 61 retracement level. Then maybe we get this move to a C, right? So these are the levels that we should be looking at to get into the F fund if you want to get this move on the C, right? So that's kind of the day-to-day drilled in technical analysis stuff that we're doing for our subscribers if you're not already a member. Okay. TSP fund charts. So like we always do the 3-year weekly charts, and only reason we do it for 3 years is so that we can include COVID right here. So our baseline on a weekly basis is we're looking at the relative strength indicator, the 20-week moving average line, and price, where each one of these rectangles is 1 week of price movement. Okay. So ever since COVID, once price got above that 20-week moving average line, every time it corrected down, it got support, right? Kept getting support at that 20-week moving average line all the way along until January of this year, when that support failed. Now the 20-week moving average line becomes resistance. Yes, you get a little bit of an overthrow, but every time it's come up and gotten above that line, it can't stay up there. And the only way that we can get a sustained bull market going forward is if price gets above this blue line and stays there. It doesn't have to rocket straight back up, but it has to stay above that blue line, right? It cannot be below the blue line and mathematically have a bull market, right? So along with being above that 20-week moving average line, we want to see the relative strength indicator be above 50. So right now we're at 45, 47 and declining. We've had 3 weeks of price decline. We're below that 20-week moving average line. There's no reason to be in the C fund. That doesn't mean you should go out now and go into the G fund. You should have done that 3 weeks ago when we closed the week below that 20-week moving average line, right? I mean, if you were a subscriber, you got out actually, well, if you're a subscriber, you got out right there. But if you're doing it based on this methodology, just looking at it weekly, you would have gotten out right there. Right, there's a C fund. S fund, same kind of idea. Once we got back above that 20-week moving average line, we got support all the way along until, in the case of the S fund, it was November of 2021, and we've basically been below that line ever since. We tried to poke above it a couple times. This one, the most recent one, had the most possibility, really, because we spent several weeks along that line, but it couldn't, couldn't break out above it. And so this actually got to be really simple, because if you were here, you would just draw this channel, and if it broke above that channel, you're good, you're in. But it didn't. It broke below that channel. So next test for the S fund, it's got a pretty clear double bottom there. So we get a close down there below 1500. The next leg is down on the S fund. And relative strength right now is below 50 and declining. I fund, it's a completely different animal, right? It's holding up on a relative basis much better than the C or the S fund. We've been talking about it a lot. A lot of this has to do, really all of it has to do with the value of the dollar. When the dollar gets more expensive, the I fund goes down. When the dollar gets cheaper, the I fund goes up. And the dollar has been under a lot of pressure in the past 3 weeks. Actually, I'm sorry, the dollar's been under a lot of pressure in here, which is why the I fund was really going up. And so the dollar is getting kind of toppy, and so we're starting to see kind of a top in the I fund. We are still above 50 RSI. So the way I would look at this is I wouldn't be looking to buy the I fund here, but I wouldn't be selling it necessarily here either. If we can get support in the I fund, at the 20-week moving average line, get support and move higher from there, then the I fund is in good shape. There's a lot of talk about emerging markets, which a lot of that makes up the I fund, not all of it. The emerging market index is different than the Europe, Asia, Far East index, but for our purposes, all we have is the I fund. And as the dollar decreases in value, the I fund will continue to increase. F fund, we already talked about it, but on the 2-week basis with all the indicators in place, so far this week, we got support at the 20-week moving average line. We came down, tagged it, and recovered a little bit. So I've had people ask me on Facebook, I got out of the F fund back here, I think in this week. And I have people asking, is it time to get back into the F fund, or what do you think? And I think it's toppy, right? It looks like it's topping here on the one hand. On the other hand, we look like we're getting support at that 20-week moving average line, and we're right on that 50 line. So what I've been saying on Facebook is, if I owned the F fund here, I wouldn't sell it, but I wouldn't be adding new money into the F fund at this point either. Okay. Right. Questions?
I don't have any questions. If you guys have questions, you don't. I don't. But if you guys have any questions, feel free to reach out to us anywhere you find this video. Just throw a question in the comment section. If there's not a comment section, you can always email us at support@growmytsp.com. And if it's investment advice, personal nature, we're likely not to respond. But otherwise, we'd love to chat about anything. We get a lot of our topics actually from people who comment on the videos, and so it's always helpful, to give us some ideas of what you guys want to learn about, or what do you want to talk about. So feel free to even if it's not about from this video, right? A lot of good things to soak in. This is one of those that I would probably watch again. Like if I watched it now, I'd probably go back and especially if you're really interested in learning some of this stuff. A lot of the stuff that Jerry kind of covered there with the F fund is really important stuff that can be applied, pretty much to all the funds. I know a lot of us are kind of squeamish about being, some of the folks that watch our show, or or in our social communities or whatever, are really like totally into it, right? They're learning about Fibonacci, and they're doing slow stochastic, and all, they're obviously into the technicals. So then you got the average person like me, right? Who's like, I'm not too likely to kind of get into the Elliott wave and Fibonacci. I understand it, but I don't know if I could do it on a day-to-day and feel comfortable. You don't have to, right? You really don't.
Right.
And you take some of those away, and you stick with the moving averages, and the price movement, and the volume, the RSI, the MACD. Those are easier. I think they're easier indicators to kind of follow. And I swear it works. And if you don't believe us, go on our website, check out our performance. Regardless of what you think about it, it is pretty consistent with being on the right side of the trend, which is all we're trying to do. We're not trying to time the market. We don't have to get into explaining all that. But the bottom line is we try to be on the right side of the trend. And the only way you can do that is to see what the market's doing.
You have to be able to see the trend to be on one side or the other. And the only way you can actually see it is by looking at a chart.
Right. Yeah. You're not going to get it. You're not going to get it. Well, I shouldn't say you're not going to get it from the media. There are some folks out there that are in kind of alignment with that, but not everybody. All right, guys. Hopefully, if you're watching this on Christmas, you get back to having some fun with your family. More than likely, if you're watching this the next day or whatever, hopefully you guys had a good Christmas. Hope you had a good Hanukkah. Holidays in general. If you don't celebrate any of that, that's fine. Best wishes to everybody, and we will see you guys in the new year.
In the new year. Excellent.
All right. See you, buddy. Peace out.
Cheers.